Yes, my dear student. How are you all? I hope everyone is doing great. I am also absolutely fine. Today I am here to inform you that I'll be soon releasing my 13th edition question bank, which will be applicable for September 2025 and onward attempt. Now, I'm just waiting for MTP Series 2 for CA Final Financial Reporting paper. Once that is released by ICI, all the new question of that MTP will be also added in my 13th edition question bank, and then I'll be launching my 13th edition question bank. Got this point? Now, in this 13th edition question bank, all the new questions of November 2024 exam, RTP May 2025 and MTP both series 1 and series 2 will be incorporated. Of course, can I say all these questions which are newly added in my 13th edition question bank will be important for May 2025 exam. So what I have done, I have created an additional PDF containing all the new questions which have been incorporated in my 13th edition, so that any student who have already purchased my 12th edition question bank, they know about all the new question in MTP, RTP and November 2024 exam. And I will be discussing all the questions also in the YouTube channel. Don't worry about that. This PDF is right now incomplete because all the new questions which might come in MTP series 2 has not been added till now. Then also I will upload this PDF which is incomplete right now. I hope you have understood why it is incomplete, because in this already I have added November 2024 exam new questions, RTP May 2025 new questions and MTP series 1 new question. Right now what is not added? MTP series 2, if any new question that is not added in this additional PDF. Then also you can download it if suppose you want to practice all the questions, you don't want to wait for MTP series 2, so you can download this additional PDF. Once this additional PDF is completed, once again I will upload the new PDF in my Telegram channel. Once again I will say you can download this additional PDF from my Telegram channel. The link of the Telegram channel will be given in the description of this video. Correct? Now, whatever new question, of course, I'll be discussing all the new question. Today, I'll be taking November 2024 exam consolidation question. Very good question, interesting question that I will discuss. However, already I have issued a suggested solution for that. In that video, I have also done the discussion. But now suggested solution has came by ICI. And it is 100% same to same, exactly same, whatever solution I have provided. They have taken one assumption, means they have for one particular point they have taken two assumptions. My solution was based on one assumption. The ICI solution has given two alternative solutions for one particular point. Got this point? So let us discuss that. Chalega? Yes, sir. So you can download this PDF. Can we start a discussion of that question of November 2024 exam? Yes, sir. So you can see this is the question. The balance sheet of H Limited and S Limited on 31st March 2024 were as follow. You can see PP, financial asset, investment S Limited 1000 debenture, means investment S Limited. This is the investment S Limited equity shares, and they have also done the investment in the debentures in S Limited 1500. Correct? Means they have done the investment in the debentures of S Limited. Then inventory, financial asset, trade receivable due from S Limited 160 lakh. So this 4000 include how much due from S Limited 160 lakh. Okay, sir. Dividend receivable is coming. Dividend receivable, there might be some dividend income receivable from S Limited. There might be. Correct. So this is the total dividend receivable. Cash and cash equivalent. Then they have given equity, equity share capital, other equity, retained earning. 13% debenture of rupees 100 is 3000. Current liability, financial liability, trade payable due to H Limited 120 lakh. Due to H Limited it is 120 lakh. Now dividend payable 400. One thing is clear, there is some dividend payable and dividend receivable. So this will become intercompany balance to the extent of parent company share if it is declared by subsidiary company. Of course, declared by subsidiary company, so it will be receivable by parent company. Correct? Other liability they have given. Additional information what is given, point number A. On 1st April 2023, S Limited had 400 lakh shares of rupees 10 each and 3000 lakhs in its retained earning in other equity. So on 1st April, S Limited had 400 lakh of 10 each, 400 lakh shares of rupees 10 each. H Limited acquired 80% shares of S Limited on 1st April 2023 at a consideration of 5800 lakh. You can see 5800 lakh, so it is coming same amount. means there is no other investment given in the question. 80% already given. The following changes in the book value of identifiable net asset of S Limited as on 1st April 2023 are to be considered for arriving the fair value of INET and to record the changes in their fair value as on that date. The fair value adjustment information has been given. These changes in fair value are to be considered while drawing consolidated financial statement of the group. Correct? As it is given book value, fair value, PP book value and fair value is given, inventory book value and fair value is given. The rate of depreciation on PP is 10% per annum. The rate of depreciation has been given. Already I have said whenever the question is silent about the method, always assume RBM, reducing balance method. Okay. NC has to be measured fair value based on purchase consideration. Goodwill was impaired by rupees 100 lakh. To impairment loss is there on goodwill. H Limited sold goods worth rupees 200 lakh to S Limited on credit at a profit of 20% sales. 50% of these goods still lying unsold. On this only they have taken two assumptions. Means what is the first assumption? They have assumed this 200 is cost price. If this is cost price, then we need to add 20% profit on that. But normally can I say if H Limited has sold the whatever the amount has been given, that will be sale price. So what assumption I have taken, this 200 is sale price, correct now? So this is inclusive of profit of H Limited. Got this point? So that depends upon assumption whatever you have taken. So let us take this 200 is sale price of H Limited and this will be a downstream transaction. Okay sir? S Limited issued a check of rupees 40 lakh in favor of H Limited as a part of payment of the goods purchased from its on March 2024. The check is yet to be transit. Means can you see the difference? You can see 120 lakh and 160 lakh. The difference is 40 lakh and that will be check in transit, that will be eliminated. Dividend payable represent the dividend declared out of its pre-acquisition profit. So dividend payable out of pre-acquisition profit. Okay, this become dividend declared but not paid. Dividend declared but not paid. Got this point? H Limited credited its share of dividend from S Limited to its profit and already the entire dividend received has been recognized in the books of S Limited and that it has been transferred to PL account of H Limited. Prepare consolidated balance sheet of group as on 31st March 2024. Correct? Question have you understood? Let us come to the solution now. Are you ready for this? Now let us come to the solution. Okay. Already I have drafted the solution. Now you can also refer the ICS suggested solution, but it is exactly the same. I am just explaining through my solution because you might be habituated as per my working note, as per my presentation. Okay sir? Yes sir. The first working note 1 will be fair value adjustment. You can see in the question they have given direct information about fair value and book value on the date of acquisition. So we can take that information directly. So there are two asset they have given, PP and inventory. Fair value has been given, book value has been given. So we can find out fair value gain and loss. In essence, now fair value gain and loss is calculated on the date of acquisition. What is the date of acquisition? You can see the date of acquisition is 1/4/2023, means entire 12 months of the current year will be the post acquisition period. It means now we will do some post acquisition adjustment. So for PP, we'll find out additional depreciation for the post acquisition period, means 12 months, because it is RBM. So we'll take fair value minus opening balance. So fair value is what? 2,800. Opening balance is also 2,500. Difference is 300 into 10%. For 12 months, it will be 30 rupees. Correct? 30 lakhs. All figures are in lakhs. Okay, sir? So this become the net changes on the date of consolidation. For inventory, because the question is silent, we'll assume inventory remain unsold and therefore there is no adjustment during post acquisition period, and the net changes during the net changes on the date of consolidation will be minus 300. Understood? Fair value adjustment. Now let us come to working note number 2, analysis of profit. We'll take closing balance from the subsidiary company balance sheet and opening balance from the additional information. This will become profit after dividend. Now they have given dividend declared but not paid in the current year. You can see in the balance sheet of subsidiary company there is one dividend payable. Dividend payable, it is already given the question that dividend payable represent dividend declared out of pre-acquisition profit. So it means, can I say we need to add back dividend payable. So dividend, it is dividend declared but not yet paid. Dividend declared but not yet paid. So we'll add back. Why? Because it is already recorded. So can you say this become 2,400 become profit before dividend. Now it will be allocated between pre and post acquisition profit. Now, because the entire 12 month of the current year is post acquisition period, therefore entire profit will be allocated the post acquisition profit, and the opening balance will be the pre acquisition profit. So we can find a pre and post acquisition profit before dividend. Now dividend will be, whatever dividend is payable will be deducted. Here you can do mistake. Why? Because of the language of the information. They have given dividend payable represent the dividend declared out of pre-acquisition profit. It means whatever dividend has been declared in current year, that is the final dividend declared in current year, but for previous year, so of course it will be out of pre-acquisition profit. It will be out of pre-acquisition profit, because in the current year, if you are declaring any dividend of previous year, that is declared out of previous year profit, that represents pre-acquisition profit. It does not mean you are supposed to deduct from pre-acquisition profit, because it is not yet paid. If it is not yet paid, so can you say it will not affect the net asset on the date of acquisition? So dividend payable will be the outstanding on 31st March. So this represents the liability on the date of consolidation. It represents liability on the date of consolidation. Therefore, always deduct from post acquisition profit. The dividend payable is deducted from post acquisition profit. This point have you understood? This is 3000 and 2000. This point we got it. This become analysis of profit. Now we'll prepare statement of net asset. So on the date of acquisition, on the date of consolidation, it become post acquisition profit. Equity share capital is already given. We'll take retained earning, will take from AOP. This amount will take 3000 date of acquisition and 2000 post. This become total, and this is the net asset. This become the net asset on the date of acquisition, on the date of consolidation, but before fair value adjustment. Now we'll do plus minus fair value adjustment for PP and inventory. This I hope you have understood. This is on the date of acquisition, and during post acquisition period we have done the adjustment, and this become the fair value on the date of acquisition, correct? And this become the post acquisition profit, which will be allocated to parent company and NCI in the ratio 80% and 20%. That allocation we can do easily. Now we'll come to the calculation of goodwill or gain or bargain purchase. So that is, they have already given cost price of investment, that is 80%. It is given in the balance sheet 5,800. Now in this question they have given NCI need to be measured by fair value method. To will find out a fair value of 20%, correct? Now let me 20%, but they have not given the, you can see NCI is measured by fair value based on purchase consideration. It is given. So can you say it means purchase consideration 5,800 represent 80%. So how much is 20%? So we'll do proportionate calculation, that we can do 5,800 divided by 80 into 20. This become the fair value of NCI based on the proportionate method of purchase consideration. This become total. From this will minus fair value of INA on the date of acquisition, which amount? This amount will be deducted. This become fair value of INA on the date of acquisition. This become full goodwill. Why? Because here NCI is measured by fair value method. Of course we'll calculate full goodwill. Now impairment loss is already given the question. Impairment loss, how much given the question? Just check it. It is 100 lakh. So 100 lakh will be deducted, and this become the carrying amount of goodwill to be appear in the balance sheet. Now this impairment loss, because it is full goodwill, it will be allocated to both parent company and NCI in 80% and 20%. Okay, sir. Now we'll come to unrealized profit. Already I have said that ICI have taken two assumptions. 200 lakh, if you assume it is cost price, then there will be some other adjustment. However, we have assumed that 200, whatever is given in the question, that represents the sale price of parent company. So this becomes sale price of parent company. On this unsold goods is 50% unsold goods, and the profit margin they have given 20% of sales. So 120%, this become URP. Unrealized profit is 20 lakh. Got this point? Yes, sir. Now we'll come to the other equity. Now because this is downstream transaction, this 20 lakh will be adjusted with the consolidated retained earning and stock in the balance sheet. Now we'll come to the other equity NCI. This balance will take from the balance sheet of parent company. This amount will take from the previous working note of goodwill, means the fair value of NCI on the date of acquisition. Now we'll add share in profit of subsidiary company as per working note of Sona. This we can get. Then minus unrealized profit, that is this 20 will be deducted, and impairment loss on goodwill will be also a portion between parent company and NCI. The last adjustment, which is also thoda sa interesting adjustment, is what about debenture. Already we have understood debentures of subsidiary company is held by parent company. Now what is given the question? You can see, if you read the question carefully, so 13% debenture of rupees 100 is 3000. This is 3000 lakhs. Means can I say there are 30 lakh debentures, out of which how many debentures are held by parent company? This is 1000 debenture. So what is nominal value? Nominal value is 1000 into 100 means 1 lakh, and they purchase at rupees 1500. Correct? It means can I say their cost price 1500, but the nominal value is 1 lakh. If you want to cancel it, there will be a loss of 1499 lakh. This loss of 1499 lakh will be adjusted with consolidated retained earning. Means this will be cancelled. Debenture nominal value of S Limited means, are you able to understand what 1 lakh will be cancelled from debentures, and this entire 1500 lakh will be cancelled from investment, and the balance will be adjusted with what? Balance will be adjusted with consolidated retained earning. So there is a loss on cancellation. So loss on cancellation, you can see 1499 lakh will be adjusted with retained earning, and this will be the balance of retained earning and NCI, which will come in the balance sheet. Okay. Then there is one elimination transaction, elimination of trade receivable and trade payable. There will be a check in transit of 40 lakh. This will appear in the cash and cash equivalent of the consolidated balance sheet. Now we can prepare the balance sheet. The PP will come book value plus fair value adjustment. So there is a fair value adjustment on the date of consolidation is what 270, that has been added. Goodwill will come as per the working note. Inventory will be book value plus one fair value adjustment, means minus one fair value adjustment minus 300 lakh. And this one URP 20. This you can calculate. Trade receivable, how much cancellation you do, book value plus book value minus cancellation is how much? It was 160 lakh. So minus 160 lakh cancellation will be done. Then cash and cash equivalent will be book value plus there is one check in transit of 40 lakh that will be added. This will be the total of balance sheet. Equity share capital will be as per parent company balance sheet. Retained earning will be as per working note. NCI will be as per working note. Borrowing, it will be 3000 minus 1 lakh, that intercompany debenture which has been cancelled. So this will be 2999. Then trade payable will be book value plus book value minus cancellation, means minus intercompany balance, that is 120 lakh will be cancelled. And the dividend payable, this is interesting. Dividend payable is 400 and dividend receivable is 400 into 80%, which is already coming in the balance sheet of parent company. That will be also cancelled to 400 minus 80%, 320, that will be cancelled. The dividend receivable will now not be appearing in the balance sheet, that will be cancelled, and the balance represent the share of NCI, that will become the liability in the consolidated balance sheet. This will be shown under current liability, means under financial liability only. Under other current financial liability we can say, okay, this will be 80, and other liability as per the information given, that is book value plus book value. There are some other liability also, I think so. Yes sir, this 1500 will come in the balance sheet, and this is the entire solution. I hope you have understood. And if you have understood, do like the video and share this video with all your friends, and subscribe the channel if you are new to this channel, because I'll be coming with all the new question which has been incorporated in my 13th edition question bank, which are the new question of RTP, MTP of May 2025 exam and November 2024 exam. Got this point? Okay, all the best for your preparation. Bye bye, love you all. Bye bye.